So a few things, a few ideas about angel investors and angel investment. What is the role of angel investors? Some people may think that this role is very easy. They have to provide money to startups and maybe nothing else. And I think that this relationship between the entrepreneur and the investor, the angel investor, is a little bit more complicated, and it is not properly described by this painting, because the whole story is here. These are the entrepreneurs, and they beg for money, they need money, and to get money they have to submit their proposals, their business plans to angel investors, and the next step is that the angels select the best ones, and then they incubate them, provide some money and managerial help, and at the end of the whole process they get to heaven together, and they get rich together. So it's maybe an idealistic picture, but it can be rather far from reality, and it's very easy to find very interesting examples. So what happened with the relationship of Steve Jobs and Mike Markula, who was the angel of Apple many years ago? And Mike Markula, who made a lot of money at Fairchild and at Intel, was asked to be the angel investor for Apple, and he injected a lot of money into the company. I think many of us would like to get to some. And he became a third partner, Steve Jobs, Steve Wozniak, and he was the third one. And he was employee number 3. So he's really joined the company, and his name was on the payroll. So it is how the story started at the end of the 70s. But a few years later, he fired Steve Jobs. Can you imagine this situation, to fire Steve Jobs from Apple? And it is what happened. And he said that he thinks that Steve Jobs lacked the discipline and temperament to manage this company. I think it was a very tough decision to fire Steve Jobs and to fire one of the founding fathers of this company. He made it. And what makes the story more complicated and more interesting, that Steve Jobs returned later, yes? And then practically Markula was fired by Steve Jobs. He left the company. So it's not this picture, it's a very interesting and very turbulent marriage between an investor and an entrepreneur. It was a crisis. It was a management crisis. So Steve Jobs was fired at the end of the company's crisis. And it is what we teach at the management school, that the life cycle of a company, of a startup, is full of crisis periods. It's a combination of evolutionary and revolutionary periods. And there are typical development phases in the life of a company: creativity, direction, delegation, and so on, and so on, and so on. And there are crises between these phases. And maybe the story is that Steve Jobs was very good in the phase of creativity. He's a very creative person. But when discipline was needed, and professional management was needed, and human resource management and systematic management became important, then he had to be fired. He was not the right person to manage the company. But after some development phases, he could return and support the company and help the company again. So it's a very interesting thing, that what is happening with this relationship between the investor, the angel investor, or later venture capital or equity investor, and the company itself and the founding fathers of the company. Of course, the entrepreneurs must live together with investors because they need money, and they have to live together with very different kinds of investors. Fools, friends, and family. I know that one of our guests, Gabor, doesn't like this word, that fools. Somebody who invests at the very beginning when nothing is clear into a company. Later, angel investors and venture capital investors, equity investors, and the final step can be to go to the stock exchange. They have to live together because they need each other. The entrepreneur needs money, and money needs innovative ideas and good companies. And if we push all these things together, we see a very interesting picture. That your company, it's possible that as you grow and you start to get older, you will grow through all these development phases, and at the same time you have a business life. You start the whole thing with a business plan, and then there is the period of growth and maturity at the end. And there are specific periods when you have to work together with different kinds of investors. So many interesting questions can be asked that how can companies, how can investors survive these development phases? Are all these phases in harmony with each other? What are the roles in each phases? Who can contribute with what in the different periods? What kind of knowledge and skills are needed? What kind of tensions can be between entrepreneurs and investors? And how they can solve conflicts. For example, this conflict between Markule and Jobs was solved by firing Steve Jobs. So it's a rather turbulent marriage, and it is not peaceful at all, and I am very much interested what do the guests think of these periods and these crises. A few questions for today. These questions are discussed many times on meetings with angel investors. The question I mentioned at the beginning, is it a match in heaven? What does it mean to become an angel investor? How can one decide that I would like to be an angel investor? What is the typical career path of an angel investor, if there is anything like this? What do they do in practice? Okay, we know that you are angel investors, but what do you do when you wake up in the morning? And what do you do at lunchtime? And how do you work? Attrition rates, we know that the success rate is very low. So if you invest in 100 companies, maybe not more than 5 or 10 will be really successful. What does failure and success mean for an investor? How do they measure failure and success? How do they forecast failure? What do they do when they see that a company is going the wrong way? Is there such a thing as an ideal investment portfolio? If you are an angel investor and fortunately you have a lot of money, or you manage an investment fund, an angel fund, what kind of portfolio you would like to develop? How do you hedge the investments, and how do you try to avoid risk, and how much risk you are ready to take? What happens when not angel investment but venture capital is needed, when the company must move to the next phase? And is there such a thing as underfunding or overfunding a company? So there are many questions to be discussed today, but before we start to speak about them, and before I invite our guests to this table for the round table, I would like to show you some statistics about angel investment and venture capital in Hungary. We are at a university, and the final and most important mission of a university is to find the truth and share the truth. And many times we try to find the truth in statistics, but at the same time we know that statistics can be very unreliable. So I hope that the statistics are rather reliable, but of course it's an interesting question whether our guests will think the same thing of the statistics as we do. So slide number 1, it's about venture capital investment and angel investment relative to GDP, and this dotted line is Hungary, it is EU, it is Hungary, and it is the average of Central and Eastern Europe. If you have a look at this graph, you can see that Hungary's average position is not best. We are somewhere between the average of Central and Eastern Europe and EU. We are below EU, but above the average. And of course, there are high fluctuations, and there is a big question mark at the end. That these figures, these lines are going down for Hungary and for Central and Eastern Europe, and EU is moving upwards. So it's only a one-time event, or we are at the beginning of a negative period. So I am very much interested at what will happen in the future. I think it's a really exciting question. Venture capital raise per year. Per year you can see the big fluctuations again, but the average is not bad at all. So I think that to raise 360 million American dollars per year For venture investment, it's a not bad figure. It looks to be enough. Of course, the difference between different years and different periods is very, very high. Very, very high. So you can see an interesting pattern on these statistics and on this slide. You can see, for example, that at the end of the period on this slide is finished with the golden age. That suddenly venture capital's role in the economy started to grow very fast, and these were the golden years between 2005 and 2008. Yes, they played a very important role in Hungary and in the Hungarian economy, and then in 2009 they practically disappeared. It's a very interesting thing again, that what happened in these golden years. Is it possible to repeat these golden years, or it was a one-time event? And of course, it's interesting to try to find the reasons behind. There are good years and bad years. Some people, some experts think that the cyclical movement of venture capital investment is related to election cycles. And you know that in Hungary it is very important. So economic policy is changing. It is really connected to election years. These were the election years. I highlighted them with these red dots. So it's a question again that is it true that investment is related and the interest of foreign venture capital funds is related to political cycles in Hungary. Some other things that there are other explanations. And behind the golden years there was a very important phenomenon, and it is related to big buyouts by equity capital investments. And you can see that there are interesting contradictions on this slide, that the value of investment is growing, but the number of the deals is decreasing very fast. So it means that the investment became bigger and bigger while the number of the deals went down. And we can see an opposite thing at the end, that here the value is going down and the number is going up. And maybe the reason is that Jeremy Fund, the Jeremy program, was opened in Hungary, and there are more deals, but till now the invested value is rather low. So it's another question to discuss, that what can we expect from these Jeremy funds and how they will operate in the future. I would like to repeat the same thing I mentioned a few minutes ago, that you can see that this growth in the golden years was closed by global funds, not local funds, venture capital funds, not regional funds, but by global funds. They appeared very suddenly and very fast, and at the end of the golden years, they simply disappeared. So we can see that global capital can move very, very fast. Where they appear, they contribute to growth, but they can, when they do not like the environment or when they do not like something, they can disappear practically, and then in the next year you can see that the investment of these funds is practically zero. So we have to be prepared that it's possible to create a rather attractive environment for them, and they can become interested in the country and investment in Hungary or in the whole region. But when they see that there are problems, and it's another question whether these are political problems, economic problems, it is related to the general crisis, they can disappear very fast and simply disappear from the scene. On this slide you can see that the private sector plays a very important role. Of course, the government is providing some funds to venture funds and venture investment, but the most important players, especially in these golden years, were private investors. So venture capital investment is practically, the majority of venture capital investment is private investment. And you can see that at the end of the period, and I repeat the same thing, buyouts were very, very important. So the proportion of buyouts, big buyouts, were very high in this period. There were many small deals. By the number of investment and by the number of deals, there were many small, but if we see the volume, we can see that that the money was used mainly for big investments. So many small companies got some money, and there were many small deals, but of course when you speak about the volume, the big deals, the big investments were more important. Here are some hot fields of investment, venture capital investment and angel investment, and you can see that the differences between different industries and between different sectors of the economy can be very big, and differences can be very interesting. By value, I think that chemicals and materials is the most important one. So the biggest money went to chemical and materials, and maybe by value number 2 is medical and healthcare industry, and third one is communication on this chart. It is unfinished, and you can see the differences that for example this money, and it's a big amount, was used only for a few deals, and the size of the investments in this industry were rather high. But at the same time, in communications, we had many deals, but the average size of the typical investment was relatively small. So if you compare these two figures, that it is over 100 and it is 8 only, you can see that big differences can be observed between different industries. And it's another question that what kind of industries are really interesting for angel investors, and this picture is realistic or not. Otherwise, liquidity is important, and I think that the liquidity of venture capital investments is rather good. You can see that at the beginning, the investors only invested, and then they tried to get back their money, and these figures are going up. So I don't think that these figures are negative, and I think that liquidity makes the whole market and investment really attractive. And finally, I would like to summarize some conclusions. All these slides and all the statistical data were compiled by Judith Karsai, who is a researcher at the Institute of Economics of the Hungarian Academy of Sciences, and I simply copied some of her conclusions based on these figures and on these statistics. The first few are really positive. She thinks that there is a rather developed and rather sophisticated angel investment and venture capital industry in Hungary. And if we compare Hungary's performance with other countries in the CEU, region, our position is not bad. We know that there are some problems at the end of the periods, and the picture may change. Hungary was for a long time #1 in this field. Nowadays, Poland is more important. But of course, we know that Poland's market is 4 times bigger than Hungary, so they have 40 million inhabitants. So it is very difficult to make some comparisons, but the general picture is not bad. But at the end, he or she says that for smaller businesses, startups, it is difficult to find investors. So money is available for the growth period, money is available for big buyouts, but for startups, for innovators, it is nowadays difficult or more difficult to find investors, and financing innovation is a hot problem in Hungary. It is one of the questions I would like to discuss with our panel. What do they think how can we develop the balance? How can we make the balance better between money and innovation? So what is needed? More money is needed, or more innovation is needed, or maybe more knowledge is needed.